Thanks for watching Lessons in Minutes with Jaylee. Like, share, and don't forget to subscribe.
So let's explore the concept provision for doubtful debts, otherwise called provision for bad debt. So you will hear either of the term. They are the same. At the end of the session, you should be able to understand why provision for doubtful debts are made. So you should be able to explain to anyone why provision for doubtful debts are made in the accounting books. And in doing that, let's get into it. What is a provision for doubtful debts? It's an account showing the expected amounts of accounts receivables. Yes, we're talking about our debtors. We're talking about our trade receivables who at the date of the statement of financial position may not be able to pay their outstanding balance. That amount that is owing to the business. And we're going to explore the big concept. Why provision for doubtful debts? Why do we create provision for doubtful debts accounts in our accounting records? And of course, the first one is to is that it attempts to allow as accurate as possible a calculation for bad debts for the year in which the debt occurred. Also, it allows for as accurate a figure of debtors at the date of the balance sheet. And we're talking about the statement of financial position for the business. And the final one is it ensure that the balance sheet gives a true and fair view of trade receivables by quoting not just the total of all balances in debtors account, but then making a deduction for an estimate of doubtful debts. When we move over to looking at the accounting entries for provision for doubtful debts, you would see that in preparing your financial statement, in preparing your balance sheet, the value that you show for your debtors will be decreased by the provision for doubtful debts. But why is this done? You want to be prudent, and basically, you don't want to overstate the assets of the business, as trade debtors are reported net of doubtful debt. So you want to show a true and fair view of the figure that you show that you report for your debtors, the actual value of your debtors. So you're estimating the value of debts that may not be collected. So you're making a provision for those debts that may not be collected. Hence, that will decrease your debtors. And again, in the lesson on accounting entries for doubtful debts, you will see this coming up because we'll be doing a practical example of preparing a provision for doubtful debts account. Now, let's look at estimating provisions. And we're looking at what businesses do in order to estimate the provision. How do you know how to estimate it? And we're going to look at two things. The first one, by looking into each debt and estimating which ones will be bad debts. So you look at the debts that you have in the business and estimate which one will be bad debts. Another is by estimating on the basis of experience what percentage of debts will result in bad debts. So by experience, businesses may be able to estimate saying probably 5% of their debtors for the period may not be able to pay their outstanding debts. And of course, that will reflect as a provision for doubtful debts. Some businesses, they use what is called a schedule of aging, an aging schedule of doubtful debts. And this basically shows how long the debtor is owing, and they'll use that to determine how much percent of the debt may not be able to be collected from the debtor. But some businesses don't bother to go into this long thing and doing the whole aging schedule for doubtful debts. What they'll do is just to estimate based on their experience the amount of the percentage of the debt that may not be collected. So therefore, they use that percentage to determine how much of that debt will not be collected and then make a provision for this. And do remember, it is prudent that this is done because you don't want to overstate your debtors and you want to show a true and fair view of the figure that you report as your debtor within the business. So with all of that said, the objective was to ensure that at the end of the period, at the end of the lesson, you'll understand why provision for doubtful debts are made. And in summary, a provision for doubtful debt is created in case some of the outstanding debts are not paid. So you estimate how much of the debt may not be collected, and you create this provision. In case some of the outstanding debts are not paid. But the thing is, please note that the provision is charged to your profit and loss account and then deducted from your debtors in your financial statement, your balance sheet, your statement of financial position. In our next lesson, we will explore the accounting entries and you'll see definitely how you will treat the provision for doubtful debts in the accounting records. So stay tuned for that lesson on accounting entries for provision for doubtful debts.
Like, share, and don't forget to subscribe.